or just 20 after 12. We'll get going with the real content today. But first off, thank you so much for joining me today. Thank you for introducing yourselves and sharing a little bit about what your background is. Helps me to give you a personalized message today in presentation. I do have a scripted stuff, but I don't, Greg knows me. I don't like going off a script. None of this is scripted. It's just me using my knowledge, and as a result, I'm able to kind of tweak it based on who's here today. So we have some people that were in real estate, so a couple of people that are newly retired, a gentleman was a financial advisor, a couple of people that were like self-employed. And so we all have we're all in the same boat, that we're all here in Canada, and everyone has to file a T1 tax return. So just so you know, we'll touch a little bit of the highlights right now for what's new in the tax for the 2021 tax year, and what's happening for 2022, because we're already a couple days into 2022, and there's a couple of things that are new that would be relevant to you. So first off, deadlines. It's always good to start off with the good stuff, right, Maureen? Let people know what their deadlines are. So your deadlines, it's April 30th. So if you owe income tax, you have to file your personal tax return by April 30th. They may change that, but not really. So just go with that. Let's just assume that April 30th, regardless, we're in year 3 or 4 or year 2, some year of the pandemic we're in. We all have kind of experienced 2 tax seasons now. Revenue Canada is not necessarily going to change the deadline, so don't wait for them to hopefully change it. They're not going to change it. Let's just go off April 30th is the deadline. If you're self-employed,
Dwayne, we're lucky. We have 2 extra days. We don't have to file until May the 2nd.
Don't listen to Maureen. If you're my tax client, your deadline is actually April 1st. No joke. So I'm actually working with my tax clients this year because I don't want to work. Nor does Maureen. I don't want to work on May 1st. I don't want to work on April 30th. I will, but don't make me, because I'll charge you a premium. So generally what I'm offering my clients is, if you work with me and we get stuff done April 1st or a little bit after, there'll be one rate. If you make me work on April 30th, I'm going to charge you a premium, because there's only so many hours available on April 30th. I have one of my clients, she already has, she's filling her expense report in now. I did my bookkeeping, my own personal bookkeeping. I did on Tuesday this week. I've already calculated my HST return. I know I'm not going to pay the money yet, because I don't have to send the money to Revenue Canada yet, but I already know what my HST owed is, because as of December 31st, you're done, right? I've done all my billings. I've done all my expenses. I downloaded my statement from my credit card transactions from Capital One, uploaded into QuickBooks, crunched a bunch of numbers. I'm done. I know pretty much what my taxable income was, and I know what my taxable expenses are already. What I have to wait for is I have to wait for my T-slips. I have to wait for my T4As. I have to wait for my T3s. I have to wait for my T5s. And generally those aren't available to mid-March. Your employers have to issue your T4 before February 28th, but we have to wait for the T-slips to mid-March. But other than that, we can calculate. If you're self-employed and running a business, you can calculate all your bookkeeping, all your expenses. You can get all that done in February. Why? Because we want to be able to calculate, potentially, whether you believe it or not, how to calculate your RSP contributions, whether you owe money. No sense of waiting until April 30th to find out if you owe money, because you can't make an RSP contribution in April. You can only make an RSP contribution. I'm going to, again, use March 1st. I don't going to look at the calendar. Maybe the calendar says March 2nd, March 3rd. I don't care about that. Go with this traditional March 1st. Don't change those dates, because then next year you think that, oh, it's always, no, just use March 1st. Better yet, use February 28th. Don't make your financial advisor like David, don't make him work on like the last day of the month. And then you're buying mutual funds when everything's high, because everyone's putting so much money into the markets. Buy on a regular basis. So if you, again, with myself, I work with clients right now. We're actually doing it right now, January and February, calculating potential income tax owed to figure out whether they want to make an RSP contribution or not. So those are some quick things. They just announced the inflation index is 2.4%. So all the tax brackets just went up a small amount. So the tax brackets each went up a little bit. Doesn't really matter to the average person, but they did go up a little bit. The CPP and EI numbers are going up. So guess what? If you're an employee or if you're self-employed, your CPP contribution amount just went up a little bit more this year. Exact number, yeah, the spreadsheet calculates the exact number. If you want the exact number, message me and I can send you the exact numbers. No one really cares about exact numbers. It's a few dollars more than last year. Guess what? Inflation, everything goes up anyway. Something interesting to know for those who are retired or newly retired or soon to retire, the CPP clawback number went up. This was really interesting. Actually, my partner and I, we did a financial, it was in the Globe and Mail, actually had a financial, kind of a financial literacy test. I'll be happy to report that I scored 11 out of 15. It was hard. It was a hard test. So really good. It was more like which company has the largest capitalization on the TSX? And I'm like, I don't know, maybe David knows. I did know what it was, so that was good. Anyone know what?
Between RBC and Shopify.
Shopify right now is number one. Which day it is. Yep, Shopify right now is number one, or in the article, Shopify is number one, RBC is number two. Good news is they gave you 4 choices and only one choice had Shopify as number one, so that's the one I picked. But that doesn't count to the CPP. The CPP clawback is increased to 89,000. So if you have retirement income greater than $89,000, your CPP gets clawed back, and probably even before that. So that's where we look at, I was just talking with a client a couple of weeks ago where he's 62 years old and still, he's just incorporated a business and he's still working. He's like, should I claim for CPP early? And I'm like, I used to always say no. Wait and claim CPP at age 70, you get 140% more benefits. But then I'm like, maybe you do want to claim CPP early. Welcome, Joel. I know it says Da Vinci, but it's Joel. It's my friend Joel. And I said, maybe you do want to claim CPP early. It all depends on what's your taxable income going to be when you're 70. If you have a pension or RSPs plus CPP plus old age security, and if that number is starting to be higher, then 170 or 140% more CPP just means you're going to pay more tax. So in his case, I said, yes, apply. So he's going to apply for CPP early. You don't have to spend it. He's going to turn around and put it into his tax-free savings account. You can turn around and invest it. Why not? So you can. So, but it's all personal. So I'm not saying go, if you're, I don't say go claim your CPP early. It's a personal thing. So, but if you have questions, it's to talk to a financial advisor or talk to someone like myself to do a personal calculation to see, is it a good idea to claim CPP at what time? You can claim it as early as 60 and as late as 70. You can actually claim it earlier if for medical reasons too. You can claim medical exemption for CPP. Okay, so what else is new? So for 2022, the Ontario government announced their staycation plan. So yes, Joel, you can go up to Muskoka. You could go up to the Marriott at Muskoka, and you could stay over. You can stay for 2 nights and pay $1,000. Keep your receipts because that $1,000 it will trigger a $200 tax credit. People say, oh, $200, better than nothing, right? $200. For a family, it's a $2,000 credit, which equals a $400 tax credit. Has to be a vacation in Ontario, and it has to have receipts. So things like if you went to a resort, rent a cottage, stay at a hotel, stay at a resort, all those things can be claimed on that vacation. Yes, Greg?
Is 2 people a family?
That's a good question. 2 taxpayers. So.
What?
Yeah, what was the question?
Oh, just so is a family. So when I say it's
a family,
two like yeah. So you have 2 taxpayers. So generally it's $1,000 per taxpayer, but or family with kids. So kids, there's not extra money for kids.
So if you have a single mom and she
there you go. I learned something new. That's this year.
New for 2022. So you'd file it on your 2022 tax returns, not your, right now we're about to file 2021 tax year.
Yeah.
This
For
is
next
for the
year.
2022
Oh,
tax
okay.
season. Yeah, so that's brand new. Also a slight adjustment from last year for 2021 for this current tax season. The working from home tax credit is increasing to $500 because it goes back to $2 a day. Last year, it was as of March. Remember, we didn't start, the pandemic didn't start till March. So the 2020 tax year had a 200-day limit. It was $2 a day for 200-day limit. This year, it's as of January 1st. So the $2 a day to a cap, I believe, of $500. There's, if you did it last year, there's also two methods. There's the $2 a day, you don't have to keep any receipts, or you could keep the receipts and claim other things. Generally, unless you're paying rent, if you have a mortgage, generally the numbers don't calculate out well for the detailed method. We've done it for clients. If you're paying rent and you can allocate 30% of your rent to your designated workspace, then potentially the rent method does add to some additional tax credit. That's a bit new. Things that aren't new, but you may not know about them because they've been there for 2 years now, but lots of people didn't know about them. If you're an employee, there's the digital memberships. There's a tax credit there. So for example, my partner claims her Globe and Mail online subscription. So you can get the tax credit for that. There's also the $250 a year education tax credit. So it's a tax credit. So if you're taking courses like tuition, you get the 16% tax credit, but this is a tax. So it's cumulative. So if you didn't use it last year, you have $250 from last year plus $250 for this year. So you have a $500 education credit. Those were somewhat new. That's about it. Again, just all the other numbers are scaling up. The RSP contribution room is increasing, so that the limit's up to almost just over $29,000 now is the maximum annual contribution. Again, it's the percentage. So again, if you're and the tax-free savings, it's staying the same at $6,000. So if you're kind of my age or a bit younger, and you've never made any contribution to your TFSA, you're now with about $81,000 of TFSA tax-free savings room. Good time to use it. And there's some strategies around January, the tax-free savings account runs January to December. So as of January 1st, you have a new $6,000 worth of limit. Super important to make sure that you're monitor that, because there's some really nasty penalties if you over contribute to your tax-free savings account. Also, for those that may be retiring and moving out of the country, it's super important that, or if you kind of move in and out of the country, not retired. I had a client do this, that she was out of the country for 4 or 5 years and came back. And she thought she was accumulating her tax-free savings room each year while she was out of the country. That is not true. It's based on your tax return. So if you don't file a Canadian tax return because you're out of the country, you don't accumulate that room that year. Super important. There's been some really big CRA Supreme Court cases where the Revenue Canada really does not like people abusing or over contributing to their tax-free savings account. And the penalty is almost like double the amount that you contributed. Lots of people don't do it on purpose. They do it by accident, but ignorance or not knowing is not an excuse with Revenue Canada. You can't say I didn't know. Revenue Canada just does not accept that. Same with saying I'm late. I have a client right now, a potential new client, and he hasn't filed tax returns for more than 5 years. And I'm like, we don't have an excuse. And Revenue Canada doesn't really there's no excuse department at Revenue Canada. We just file it, and you can ask for kind of lenience afterwards, but just not filing a tax return isn't a great reason. So, right?
So you're saying that if a person hasn't filed a tax return for the last 3 years, not 2021, but the 3 years prior to that, and that was supposed to be $6,000 a year, they lose that $18,000. Instead of if they've never contributed, but they filed tax returns, instead of having 81, they're going to be 81 less 18,000.
If they didn't file
about
tax,
others, but I can't hear Greg.
yeah, Greg, your mic's light this today.
That's for once. What I'm saying is, if the person hasn't filed 3 years worth of tax returns, not the year that we're coming up now, do they lose that?
No, well, depends what you mean on by not filing. What I'm saying is, if they've, in this case, they weren't in Canada, so they weren't a Canadian resident for those 3 years. If you're not a Canadian resident for those 3 years, you don't accumulate room. If you haven't filed a tax, if you just didn't file a tax return and you go and you do the catch up and file a tax return, you still have that, you'll get that retroactive room back.
Okay, because you said if they hadn't filed a tax return, so it's residency rather than tax.
Yeah, so she didn't file because she was in this case, so I'll just clarify. In this case, she was a non-Canadian resident for 4 years. She was living in the Middle East. So as similar, I have colleagues that are moving to Costa Rica. So, and that's the other thing. So I'm not going to touch on that today, but it's always good to seek advice. If you leave Canada, there's some serious tax implications on that, including withholding taxes. So I have a client who lives in Mexico. So you have to register. So he pays withholding tax on his CPP when it leaves the country. If you physically decide that you're going to leave Canada, all of your assets are pretty much, you're disposing of all of your assets at that point, and it can trigger a large tax liability. So you want to make sure, are you leaving Canada? And there's some tests around whether or not you have enough. Again, I have someone I know is moving to the US, but just temporarily. So they're holding still kind of some ties to Canada. So again, you could be a non-resident without declaring that you're leaving Canada. It's just be cautious. Maybe most probably is no one that's here, but there's some people that are really not so happy with the Canadian and being locked down. So it's like, I'm out of here, and they're leaving to other countries. And if you have RSPs, if you have investments, if you have pensions, pretty much as you exit, those are I'll share the recording. Yep. So when you exit, you pretty much have to sell all your if you had money in your tax-free savings account, you have to sell all those things. More so if you have money in your RSPs. And similar to clients who say, I'm going to retire as a teacher and I'm going to take all of my pension out. I want to manage my own pension. Fantastic. You can move it into a LIRA. David probably knows about this. You're going to move it into a LIRA, which is a locked-in retirement plan. But if you want the money out, and I have a client actually wants the money out and wants to manage it himself, it's like, think twice, because you're bringing all that into taxable income. And
if you're over 55, you couldn't anyways. Can't commute it after 55.
Yeah, so it's tricky. I also have someone I know who has worked for OPG, Ontario Power, and when she retired, she's like, I want my money because I want to get into real estate investing. So she did it, but it gets really, you pay a really hefty expense tax bill on the way out. So there's it's all around tax planning, right? So everyone, it's all about your own risk and how you want to do it. Understand that, but just don't do anything drastically. Make sure that you're talking to a tax professional before you go. Okay, so let me just, how are we doing? Anyone? Okay, so someone had to go and they had to go. That's okay. So I am recording today's talk. Questions so far? I'm going to just pull up. Just give me 1 second. I'm just going to. I'm going to pull up the formal PowerPoint presentation to kind of breeze through that. And but while I'm doing this, I'll say now, hit me with your questions.
Yeah, I had one question, Dwayne. Thank you for so much for organizing the session for us. Uh, I am a regular employee at a company, full-time employee, right? I
Mhm.
do know that some of my options of saving taxes is RRSP and TFSA, right?
Yep.
But what are the other things that I could do to save more taxes?
Yeah, it's like I planted that question because I'm about to pop open that presentation right now. So thank you thank you for that question. I didn't plant that question, but you're 100%. And this is usually in the past months. I've kind of spent the whole 45 minutes just doing this one presentation. What I wanted to do, and kind of again depends on people in the room. I want to be able to tweak it a little bit. The presentation, I don't need 45 minutes to run through this presentation. You're all knowledgeable, you're all smart people. The content is about 15 minutes worth. Hang it, so we'll get through it. It's really to show you again, it goes back to the piece that I didn't know what I didn't know, and now I do know what I know. And this is what I love sharing with new clients. And on this presentation, it really, generally it turns on the light bulb for a lot of people. Super relevant for people that are, a couple of people that are retired, that kind of semi-retired. This is the example of what my dad, and being the Avon man, this will show you, you can do this not even retired. Number of my clients do this. I have 4 or 5 clients who are registered or are nurses. So they're working in Canadian hospitals as one of my clients is a neonatal nurse. A couple clients are nurses in the Niagara area, nurses downtown. Nurses make a good wage. They're hard. They work a lot of hours. They have a nice pension, but they pay a lot of income tax. And they say, well, how do I not pay so much income tax? And you're right. There are generally, when we do the presentation, I'm a CPA presentation, a CPA financial literacy volunteer. When we go into companies, we say, you said it, and David will shake his head, like, as an employee, I was one for 20 years. There's about 2 strategies you have. It's like, put money in your tax-free savings account. It's nice, do that first. Wait till your income increases and then use your RSP. Welcome to Canada. Those are your two strategies for saving money.
Actually, 2 more.
There's a couple more. All right. What's your
Charitable gifting, flow through shares.
And flow through share. So yeah, so yes, donate money you can donate money to charities, but you still kind of have to have money to give. You have to have money to give money, and that's good, but it doesn't really help you in retirement as you approach to retirement. Or how do I make my money make money? So yes, tax-free savings account. I've been using mine for the last 2 years. My tax-free savings account is doing really well, because we put in equity stocks. I can't give you stock advice. I'm not licensed to give stock advice. I'm going to say I put in stocks into that TFSA that paid dividends and that have capital appreciation, and Canadian blue chip, and it's done really well in the last 12 months and more. It's a long-term play for me. RSPs is also good. The thing that you want to do is you want to manage your tax bracket. So when I was young, when I first started my first corporate job, I was putting money in because my company, my job, my employer gave me RSP money. Do that. I can't believe that now they say so many millennials or young people aren't taking advantage of the 1 or 2% that their employers will give them. If your employer's giving you free money, free money. My partner works for one of the major banks, and she takes full-blown advantage of the employee stock purchases and stuff that the banks, or if your employer is offering any of that stuff, take advantage of. That's free money. Why would you not do that? The second part, though, is on the back end of the RSPs is that you have to pay tax when it's not a tax avoidance. There's no tax avoidance strategies in Canada. There's a tax deferral. Tax avoidance is illegal. Tax deferral, including, I'm not even going to talk about it today but probably at some point I'll do something around cryptocurrencies and other things where people think that that's the way to avoid tax. You're kidding yourself. CRA treats cryptocurrencies like equities. So, and it's your job to do all of the tracking of when you bought it and when you sold it and how much potential money you owe. On the back end of the RSPs, it goes back to balancing what's your retirement income going to be. So you want to figure out what's your retirement income going to be when you're 70, because all of a sudden if you have CPP and OAS and you got to take out 3 to 4% out of your RSPs, what's your tax bracket now going to be? If you put money in when your tax bracket was 50,000 and you're taking money out when your tax bracket's 70,000, guess what? Revenue Canada likes you because you're actually paying more money on the out than you got on the in. I'm just going to let you sit there for about 30 seconds. I'm just going to let you say, you paid more, you got less benefit on the way in and you're paying more on the way out. Not that RSPs are a bad thing, but putting too much money in and only into your RSP, that's not a great strategy. That's a very narrow strategy. That's the strategy, no offense to the banks, that's the strategy that the banks may promote. Sorry, David, but David doesn't work for the bank. But that's a strategy that you're like the bank tellers, like just put money in your RSP, but like maybe your old financial advisor says, just put more, what's your RSP contribution going to be this year? That's a very narrow single focus. You know, I figure out what's best for you today and what's best for you at the different stages of your life. Good. All right. Let's get to the presentation. People are like, where's this presentation he keeps talking about? Share. Good news is I'm only running one screen on a small laptop today, so it's.
Well, one of the other things you do about RSP is you defer making RSP contributions when you're making $30,000-$40,000.
Yeah.
Room until you're making more money and you get more tax benefit to it.
100%. 100%. Right now, for me personally, I think I have money in RSPs, but not right now. I think my carry forward is close to 100 grand. I have like 100. I can put it over the next little while. Again, as my business grows, great, because I'm not using that right now because I'm managing my tax bracket. Okay, so here, why everyone should have a home-based business, whether you believe in that or not. Doesn't really matter about the presentation. The content's still great. It's the best recruiting tool. So if you know anyone in the direct sales network marketing industry, love the introduction because I show them how to actually convert, how they show their customers. I'm a customer. I'm not in the network. I tried it. I wasn't very good at it, but I'm a customer of, I get my protein shakes in the mail once a month. That's a business. I don't even have to make money. We're going to show you that you could just do that in your retirement, just like my dad does Avon. Avon is a direct sales network marketing business. You're a home-based business owner. Here's a really quick thing. So just as a quick thing, I think the average household income is around 75,000 in Canada. If I look at 75,000, we pay a lot of tax. Your net take home, I did a presentation when we could go into high schools, and you ask the high school kids, like, how much do you think your take home is? And a lot of them were really shocked because they didn't really understand this thing called federal tax deduction, the provincial tax deduction, the CPP and the EI. And they're like, whoa, almost $19,000 of taxes. But what I love to show people is this number here, this $10,000 amount. That's your federal income tax. And this is a number that I can actually trigger a refund. And we can trigger a refund two ways. We can trigger a refund in the traditional way, which is RSP contribution. If I contribute money to if this person making 75,000, they contribute, they go to the bank and you take out you make a RSP loan or you deposit money into your RSP, you'll get some of this $10,000 back. Depends on your marginal tax bracket. So if you're in the 30% tax bracket, you get 30 cents back for every dollar. It's not one-to-one. So some people don't realize that I made a $10,000 tax refund, RSP contribution. I should get a $10,000 tax refund. No, it doesn't work that way. Your marginal tax rate. So 30 cents on the dollar. However, those are tax credits. What we love to talk about is tax deductions. Tax credits are different. All those things we talked about, the staycation, that's a tax credit. Tuition is a tax credit. Childcare, those are tax credits, 16%. Tax deductions, tax deductions can be 100%. We much more love tax deductions. Now the great thing is, what's a tax deductible business expense? So this is just a definition. I'll get into specifics in a second, but a definition says any expense incurred for the purpose of gaining or producing income. Right? It doesn't say I have to make income. It just says gain for the purpose of or producing income. I'm in business. Doesn't say that I doesn't say I made a nickel in commissions. Doesn't say I made a nickel in revenue. I'm in business. I'm for the purpose producing income. Incurred with a reasonable expectation of results in future business. That's why I love marketing. Marketing is a business activity. Marketing is not sales, but you have to market your business. Most times you have to market your business before you get a customer. Your marketing expenses are based on the future expectation of getting a customer. So David could run a Facebook ad for his advisory business, and that cost of running that ad is tax deductible before he ever gets a customer that pays him a commission. And it also has to be reasonable under the circumstances. So yes, your car is a reasonable tax deduction, but nowhere does it say that driving a Maserati is not necessarily reasonable. And that's why Revenue Canada has tax limits on automobiles, that they're capped. All right. So how does this work? So someone asked, how do I trigger a refund? How do I save some money on my taxes? So this is a good example I love using this example. This is my cell phone. So my cell phone, actually I don't pay $100 a month, but I like round numbers. I have a degree in mathematics, but I don't make people do complicated math. So I say $100 a month is your cell phone bill. I always tell people, unless you're 100% in your business, and even then I don't necessarily take 100% of the phone bill. So most people, if you're running a side business, I say 50%. You're using the 50% business, 50% personal, because you're not on your phone all day for business. Take 50% of 100 times 12. So we get a $600 expense, this phone. For 20 years, this phone was not tax deductible. When I drove every day to my corporate job and I used this phone sometimes for my corporate job, it wasn't tax deductible. I sat at a desk. My home internet. Yes, now a portion of your home now can be tax deductible because of the working from home tax credit. But we talked about that tax credit. That tax credit is only a $500 credit. Not that great. But if you had home internet, 50%, so you're still watching Netflix. You're not using 100% of your internet for your home business. You're still watching Netflix or Apple TV or Disney or booking your vacation or something. I was talking about how you make your vacation tax deductible in a minute. So $80, I'm not sure what your internet is, but $80 times $480. Now, a portion of your car. Now, the challenges in the last year, a lot of home-based businesses, the car percentage went to like 0 because everyone's running home-based businesses and you can't go out and meet anyone. So, but I still say, well, even if you do something a little bit, at least keep track of the car, because even if it's like 5% is better than nothing. Even if we have to go to 0%, but still keep track of your car. And I always tell one strategy, pretty good one, is take this thing and go out to your car and take a photo of your odometer on the 1st of January. And that way you at least know what your total kilometers driven is. We need to know what your total kilometers driven in the year is, and then figure out the business portion. And the best way to audit proof your tax file is to have a photo of your odometer on January 1st, so we can prove. I did this in the last couple of years. So on January 1st, I went and took a picture of my car. It was 179,000, I think, and last year. So pretty much within about 5 seconds, I knew that I drove 14,000 kilometers last year. Audit proof. Yep, Greg.
If you're incorporated, you do it on your anniversary year instead of the tax year, right?
Yeah, you can, but you can still keep track of it on a calendar basis. But yeah, so you could still. Okay. It's a bit of both. But if I just said $10,000, CAA pretty much, this is a number of years ago, said the average cost to operate a car in the GTA was like 10 grand. It's probably 12 to 13 or 15 now. But I still use 10,000 for round numbers. 33,000 of the 10 of the 15, I get a $2,000 tax. So at least 2,000, because you still pay insurance, you still put some gas money in, and you still pay some stuff with your car. Home office. So home office is percentage of square footage or percentage of rooms. Again, one quick thing about home offices, especially if a home-based business, if you're already in a tax loss, you can't make your current year tax loss bigger for a refund. You can create a tax loss carry forward. You might be shaking your head and your brain might be about to explode, but that's why you hire a tax professional. but just know that you can make your home and a portion of your mortgage or your rent tax deductible. And the biggest one I like at the bottom, I even forget the second biggest one. The second biggest one is personal development. So here's a quick story. I love sharing stories, you know, as they say, facts tell, stories sell. One of my clients is out in Vancouver and she works for the city of Vancouver. She makes about just over $90,000 a year. And about 3 years ago, she spent $15,000 on Tony Robbins. Yes, she went and did the whole Tony Robbins experience. And she filed her taxes and she didn't claim the Tony Robbins experience after she found out that she could. So then she came to me and we filed 2018 and 2019. So we went back, we refiled her 2018, we put Tony Robbins in there. Why do we claim Tony Robbins? She said, well, she had a corporate job. How does she get to claim Tony Robbins? Because she has a network marketing side business. She's with a skincare product company. So she has a side business. She made $1,000 in commissions. We claim $15,000 of personal development. It triggered, well, all said and done, we triggered about a $10,000 tax refund for her. Now we had to submit receipts. Sometimes you don't have to, but when you submit kind of extreme stuff, Revenue Canada usually comes knocking and wants some receipts. No problem, we had them. It sat for a while. It took about 4 or 5 months before they finally assessed it, but she did get her check. And once she got her second check, then she went to her mom, and now her mom and stepdad are tax clients because they're like, wow, it's true. Her mom and stepfather are retired, and now they're tax clients because we show them how to save money in their retirement. The big one is, the second one is around travel. 3 years ago, we went to South Africa for 2 weeks. 1 week of my trip to South Africa was all tax deductible because one of the businesses I operate, it's based with a product from South Africa. So I went and spent a week with the founder of that business. We got to tour around South Africa, went to game reserves, and then that trip was all personal. 1 month of that, or 1 week of the 2-week trip. But the big thing was all tax deductible, which was the airfare. The airfare from Toronto to England to Cape Town's pretty pricey, 100% tax deductible. And then 2 years ago, we did a similar trip to the UK, and a good chunk of our UK trip was all tax deductible. And how do you get that to be tax deductible? Got to plan ahead. We planned those trips a year out in advance. I just didn't go while I was in Cape Town. I didn't go knock on doors and do prospecting. No. I had planned the trip. I had organized it. It was a purpose. It was directly linked to my business. The second trip went to England for a 3-day conference. So 3 days, all the time in Oxford, and the airfares to the UK, all tax deductible because I have a business in addition to not just a job. Jobs are great. I love people. I love my clients who have jobs, because jobs, you pay a lot of income tax on your T4, and then we help clients get some of that money back. So just want to run through those numbers. Actually, the basic exemption, I got to update this slide because the basic exemptions now, this is how old the slide is. The basic exemptions up to almost 15,000 now. So you can make $15,000 of income without paying any income tax. We've just added another $4,000 of business expenses. So if I take 15 plus the 4, you can make almost $20,000 of income in 2021 and pay 0 income tax. It's pretty good. It's great for if you have like spouses. So if you have like a sole income earner, and then they have a stay-at-home spouse, and they want to work a side business, that side business can generate $20,000 before it starts eating into the other person's taxes. Hire your kids. So it's not quite a kid, but I kind of did this I didn't pay her though. My partner's on vacation. She starts her new job next week, so she was off this week. So I gave her some administrative work to do. But I could have done that. I could have given that same administrative work to my 15 or my 17-year-old, and I could have them. I was setting up files. I was like, okay, I just need to put these files into file folders, label these file folders. I could give that to anybody, but I could give that to my 15-year-old son, and I can pay him. I could pay him $10, $15. I can pay him $15. I could pay him $20 an hour. It's really good to say, wow, how do you make how do you kids and dance and college and smartphones and video games and weddings? How do you make your kid's wedding tax deductible? So here's a quick example is that, okay, so my son, David, I don't know if you have kids, but really good, it's where advisors or people that, if you have administrative, social media, especially if your business is if you're generating money, Greg could hire his niece, he could eventually hire his niece, to be administrative in his mortgage business. So you pay them $20, pay them reasonable, right? It has to be, again, all those things, it has to be reasonable and it has to be realistic. So Greg can't pay his niece $100,000 to be his administrative assistant in his mortgage business, but he could pay her $20 an hour to do some stuff, to do his social media, to do some posts, do some other things. He could pay her, if she's under the age of 18, you can pay them up to, we just said you can pay them up to $15,000 to $18,000. So if you had a 15-year-old, 15, 16, 17, 18, that's 4 years, you could pay them 10 grand a year. That's $40,000 tax-free to them. And then they turn around and they use that $40,000 to pay for their wedding. Wait,
I have a point here, a question. I thought that CRA had specifically in the last 2 years looked at this and very scrutinized paying under 18-year-olds.
Again, it has to be reasonable. But again, what do you like? Most people aren't paying like 15 to 20 grand to under 18-year-olds, but you can pay them something. Because my 17-year-old son 2 years ago ran a snow blowing business. So again, there's no difference to say if they have to set up, if you could show them how to set it up there's 14-year-olds there's 14-year-olds making 100 grand a month on Amazon stores, right? So you just have to set up as a business, right? So you can't, so it all goes back to audit proofing it, right? So if all of a sudden, Dave, if there's just like $1,000 a month that you transfer it into your daughter's bank account, and you're like, what did your daughter do? She posted some stuff on my Instagram account for me. You're like, smells a little fishy. However, if she has like 2 clients, 3 clients, kids are babysitting. There's kids that are babysitting for 4 or 5 clients. They're under the age of 14. Or there's 12-year-olds that are running baby. It has to make sure you do the extra work to help them actually coach them and educate on making a business, make a flyer. My son did a post on Nextdoor. He got snow blowing customers on Nextdoor. Now I can't pay him to snow blow my driveway because I live in a condo, but my snow blowing isn't necessarily tax deductible, but it could be. So Greg had clients come to his house and he's got to do some work around his house. I have a client that lives up in Caledon. She has a beautiful property, like 2.5 acres. We write off some of that stuff because she has clients come to her home. She has a women's group. And there's like 4 or 5 of them meet in the summertime out around their fire pit. That's part of the bit, all based on income, right? Like don't over create losses, but it can be. Yeah.
You're also creating RSP room for them too.
Have them file a tax return. Don't make it all under the table. Make them file a tax return. Show it as income. Because if you're showing it as an expense, technically they have to show it as income. No different than nannies, right? Like lots of people hire nannies. Oh, I'm just gonna pay my nanny cash because the nanny's not claiming it. Yeah, you're helping her out, but you're not really helping her out because she's not creating any RSP contribution room because she's not claiming that money. So really quick, we're getting close to, we're just at 1 o'clock. But so it's a great time. More and more people are starting small businesses. People are leaving their corporate jobs. People are starting side hustles. There's like a whole wave. There's guys that have like a couple guys I know, don't know what, but just like there's side hustle podcasts. There's books about having a side hustle. It was before even the network marketing. The network marketing business is a real industry. So many of my colleagues don't want network marketers as clients. I'm like, I love network marketers as clients. I'm like, why not? It's a real business. They're offering real products to real people and making a difference. There's a number of people that are like, a lot of people are like, education isn't required. You can start up a business with next to no money. It's different than franchises. You're entitled to these deductions. Just follow these. All are by the Tax Act. And I said, there's those 3 criteria. I have a colleague that has a whole course on how to bulletproof your audit-proof your tax file. So when CRA calls, you say, when would you like to come, today or tomorrow? Not, oh, I'll get back to you in 6 months while I try and recreate some invoices. No, today or tomorrow. Hire your family. Just be careful when you hire your family. Sometimes you might have to fire them. That gets messy. I have a new tax client that her tax return didn't get filed last year because her potential ex-husband, or kind of going through a separation, and her ex-husband's sister was filing her taxes for her the last few years, and they didn't, surprise, surprise, they didn't get filed last year. Not sane, but the same. Hire an accountant. I am tax deductible for you. Yes, I am a tax accountant. I'm growing. That's why I do these presentations every month. I get 1 to 2 new tax clients for everyone that shows up here. 1 or 2 people become clients. I love that. I'm tax deductible. If you have rental income, investment income, or if you have a business income, accounting and accounting advice and advisory advice are tax deductible. And that's why my fee is significantly less if you're not just an employee, but if you're just a T4 is your only source of income. My rate's $50 an hour, $50 for a return. It's really affordable. It's like less than the price of the software. Why do I do it? Because it's that way it gets done properly, and then I advise clients on the other piece. I am a licensed CPA, so I am licensed to give advice. I charge a little bit more because you don't just get tax preparation, but you also get advice from me, like you got today. Today was free. Oh, Joel left. Okay, just reading the messages. Okay, I'm back off the screen. I'm just taking a quick run through the messages here. Much about, PPPs and IPPs. Someone was asking me about that. David, was that you, David? Were you asking about that?
Sorry, yep, was muted.
That's okay. I was like, because some people may know about IPPs and PPPs, but I'm guessing it came from the financial expert. I know about this much. I have some colleagues. There are some there's some tax strategies too. So just what PPPs and IPPs are, it's the personal pension plans. It's a different way of saving money inside of a corporate, if you're incorporated. So my understanding is
Or business owner.
Business, yeah, but it's instead of using RSP. So here's a really quick, rundown on, for those that are incorporated. Great that you're incorporated, but the great thing about incorporations is you eventually gotta figure out, how do I get my money out of my corporation? Because I still need that money to pay my mortgage or to pay for my living expenses, and I've incorporated and all my money is sitting in my corporation, but how do I get that out that's legal? Lots of people all of a sudden give themselves like owner's draw, which is okay during the year to get to live on, but you still have to figure out what's the income tax event for corporations. And generally there's 3 that I discuss, and there's a 4th one. So what I mean, you just said 3 and then there's a 4th one, but we'll focus on the 3 first. So inside of a corporation, you can set yourself up on, as a business owner, you can set yourself up on payroll. So as a business owner, you can put yourself on payroll and you can pay yourself a salary and run through, and generally you can be EI exempt, but you can have the corporation pay CPP for you because you have to pay CPP regardless one way or the other. So you can put yourself on payroll, and if you have other employees, then that's fine. You run through payroll and you pay yourself a salary. And then your corporation will issue you a T4 or a T4A, generally a T4. And then that T4 goes into your personal income tax, and you pay corporate tax at a rate of 12.5% to 13%, and you pay personal tax at whatever your marginal tax rate is. That's one strategy. Number 2 strategy is to charge your corporation a consulting fee, or you issue yourself a T4A, which pretty much means I'm paying myself, but I'm not doing any payroll deductions. I'm just going to pay myself a lump sum. So I have clients that have done this. So at the end of the year, maybe they do owner's draw during the year, and during the year they draw out 40,000. And at the end of the year, it's like, okay, I'm going to bring that $40,000 into taxable personal income. So then we just issue a T4A that says, okay, I took out $40,000 of taxable income, and I bring that $40,000 of taxable income into my personal income tax, and I pay CPP the full bang on my T1. So I got to, as a person, I got to pay both the employer and the employee portion on my T1 tax return. It's okay. It's a strategy. With those two strategies, the nice thing is those transactions are taxable income, and taxable income trigger RRSP contribution room. If you believe in RSPs, contribution room, which is nice. Third strategy is you pay yourself a dividend. So at the end of the year, you got some profit in the business, or you got some money left over in the business, and you're the shareholder, and you can dispense some dividends to all the shareholders, and you pay yourself a dividend, and you bring the dividend into taxable income. Dividends are taxed, private Canadian corporations are taxed, dividends are taxed at a lower tax rate. However, dividend income is not earned income, and dividend income does not create RSP room. And thus the IPP or the PPP comes in to say, screw that, I don't care about RSPs. I'll do a personal pension plan inside the business. And it's a little bit complicated, and you have to hire some professionals, including some actuaries potentially, and some tax professionals to calculate out based on your income and the revenue and some revenue, how much pension room you have on an annual basis. The nice thing is you can hold different assets. You're not just limited to equities and mutual funds. You can actually hold real, I believe in one or both. You can actually hold real estate as an asset class inside of those pension plans. The super nice thing, I've actually been on a couple of colleagues have done presentations, so I know a little bit more, but I don't do them. So again, if you have questions, we can do a presentation. I can bring in one of my experts, or I can do a referral introduction to some other people.
That's one of my specialties.
That's when so David is I'll keep talking. David will eventually, he'll hit me the buzzer if I say something wrong. So the super nice thing about the pension plan is intergenerational wealth transfer. So if my son
And family members,
if my 17 and 15-year-old sons, if they decide that one of them wants to become an accountant or wants to just run the accounting practice once it's incorporated, if we're both on payroll as employees and we're building up the pension plan money, and then at some point I'm going to die, and the money can be transferred to the surviving members, and it doesn't have to, there's no disposal. It's not an asset of the actual, I believe it's not actually an asset of the corporation. It's its own separate thing as well. Mm-hmm. So it protects, the whole idea is having the corporation, it protects, if someone sues the corporation, they can't necessarily sue and get access to the pension money, because the pension money doesn't actually sit inside the corporation. How am I doing? Pretty good, David?
Very good.
Oh, good.
I get caught on one that most people don't know about, is holding real estate in it.
I was at a present. I do have a couple colleagues, and I belong to a couple couple guys I follow on LinkedIn. So they run there's some tax law guys that have done some webinars.
Jean-Pierre Apport, Integris.
Yeah, I think so.
Yeah, he invented it.
And then the guy Andrew Wall at CPA for IT. He's had a guest guy come and present for them. Yeah, it's
not very well known.
No, so if that's yours, but I'll definitely connect with you after to talk about that, because it's super important to have the team together to support it, to get them set up. I had a former client set one up, and then he just wasn't generating, his corporation wasn't generating enough money, so then he tried to close it, and then closing it's just as much hassle as setting it up. Mm-hmm. But I did work for a company in Mississauga, my last corporate job, where the owner there had it set up really nice, built up a nice
Yeah, good.
pension plan. It's great tax strategies that way. So it's all about having, as they say, different horses for different courses, or different products for different clients to say. So the great thing is I have solutions from just T4 employees right up to people that are corporations. I just had a call with a potential new client today, and they've just setting up a corporation. He's got a holdco with 3 entities all set up, just registered in September, and now they're at anyways, a little bit confused. Not confusing yet. It's great, really good, because they just incorporated in September. So it's like, I need somebody to help me with some bookkeeping, some corporate returns. I have my own personal corporation too, and they've set up all this structure ready to fly. And they're kind of in this media entertainment space. So fun. Okay, let me stop the recording in case